My name's Ned Bell. I'm the Chief Investment Officer of Bell Asset Management, and this is our Q1 2020 market wrap. And today I'm going to talk about the Bell Global Emerging Companies Fund, which follows our global small mid-cap strategy. So in what's been a very turbulent period of performance in Q1, the fund actually held up relatively well in a relative sense. So the fund was down. It was down 7.3% on a net basis against the benchmark return of negative 17.3%. So the MSCI World Small Mid Cap Index did fall by quite a bit more than the broader index, as one would expect. So our fund outperformed by 10% in that first quarter. So again, held up relatively well in what was a very difficult period. When we think about the actual breakdown of the relative performance of the fund, I'll make a couple of points. So first of all, we had a very wide contribution of contributors. So 87% of our holdings actually added value or outperformed during that quarter. Needless to say, as a manager with a quality bias in a very volatile market environment, our quality bias really played a big role in making sure that the portfolio didn't fall by too much. So we didn't have exposure to the very cyclical end of the market. We didn't have exposure to stocks that have got weak balance sheets and need to raise capital, but rather have much more exposure to, for example, having more exposure to healthcare and consumer staples has been a material benefit, and having lack of exposure to energy, financial services, real estate, cyclical industrials, that's where a lot of the pain was felt. So not being underweight those sectors really did play a big part in how we performed in a relative sense. So the performance was, again, it was a very volatile period, but the fund held up quite well. In terms of the portfolio positioning, I think it's important to just touch on some of the, where the portfolio is different to the benchmark and how it's positioned in an absolute sense. So again, as a quality manager, we only invest in companies that have got very high levels of profitability and strong balance sheets. Now, the strong balance sheet part of that equation has never been more important. So, for example, the net debt to EBITDA ratio of our small mid-cap portfolio is considerably lower than that of the benchmark. It's a little over 1.5 times versus about 2.6 times for the benchmark. The return on equity of our portfolio is 24% versus around 7% for the benchmark. So having those two characteristics really underpins the portfolio in what's been a very, very volatile period. So we're obviously not happy about delivering negative returns, but we feel we're somewhat relieved that we've been able to cushion the blow to the market somewhat. In terms of the trade activity during the quarter, we've been relatively active. We've been effectively taking profits in names that have done very well for us. So we've sold positions in Coloplast, Deutsche Börse, and Electronic Arts. And two of those names, so Deutsche Börse and Electronic Arts, they went above our small mid-cap threshold before the market sold off. Coloplast did very, very well, hit our price target. We sold that for valuation reasons. And then Core Labs and Dollar Tree were stocks we sold for fundamental reasons. On the buy side, we introduced a couple of names. So Christian Hansen, one of the global leaders in the enzymes business, Danish company, was followed for a long period of time, lagged coming into the early part of this year. So we bought that before the sell down. It's outperformed materially since we've bought it. We also introduced more recently IDEX Labs and Straumann, so two quite unique healthcare names, very high return on capital. We think that they'll have much lower earnings dips as the rest of 2020 plays out, and they'll recover well into 2021. So all things considered, the portfolio, I think, has been positioned well. It's performed in line with expectations, and we think that it's positioned extremely well for, again, what's going to be a pretty volatile period. And from an opportunity perspective, we think as the volatility continues to play out throughout the course of 2020, we're going to get more and more opportunities to introduce basically the best quality small mid-cap stocks into the portfolio at prices that look really attractive. And at the end of the day, we are valuation sensitive. We're not going to pay through the nose for the best of the best. We're going to be patient. And being patient until now has really paid dividends. We think it'll continue to pay dividends throughout the course of this year. So we feel that we feel optimistic about how we've been managing the portfolio and how it's going to play out over the coming 3 to 5 years.